Awesome.
All right, we are recording.
All right.
Yeah,
Hello.
I really appreciate you guys taking the time. I know it's our first Zoom meeting, and I know with the new technology, sometimes it's not the easiest thing to get on, but I really appreciate it for the Connecticut Passive Investors Club. Our guest today, John Fortis, the founding partner of Community First Investment Group in Boston, doing big things, syndicator, investor in multiple states. So he's going to be going over syndication for us, kind of going like from a bird's eye view of what it is from a active and passive investor. We're also going to talk about a sample deal and kind of go over the numbers and kind of just get a little bit better understanding. So we did our interview either a month or two ago, I think it was.
Yeah, I believe it's around that time.
Yeah, it was very good. We went a deep dive into his background and kind of how he started out and his business and a whole bunch of strategy. It was a great call, and anyone who wants to check that out, it's on iTunes, it's on YouTube and Facebook. But for people that are not familiar with you, if you mind just very quickly kind of talk a little bit about your background and your company, and then we can jump right into the presentation.
Yeah, so matter of fact, that's part of the presentation.
All right.
I could just kind of.
All right, then I guess pop open the slides then, or however it's your show. So however you want to do it.
No worries. So how I started is I invested me and my wife invested in a single family and immediately said, look, man, we got to scale and multifamily, which I was already literally starting my education on previously, and then everything made sense. So when I closed on the single family, it was like, oh man, everybody says this. Started with single family, wish I knew multifamily. So everything made sense. And it finally, like that puzzle piece clicked. So I started investigating multifamilies, and I didn't want to just do twos to fives because it's still considered residential. I wanted a commercial because it's easier to close on those in regards to residential. With if you've purchased a house, you guys know the 800 pages you have to sign at the end of the day. So let me start this presentation and we'll get it going with this. All right, can you see that? Oh, hold on. Perfect, right there. Boom.
Yep, I can see it, good.
So when I closed on that single family, I reached out to my partner who does my taxes. His name is Mitch, we formed CNF Investment Group, and we kept looking in Florida, and I closed my single family in Florida as well. So that's why I was looking in Florida. We're looking in the Space Coast. We kept looking out there, and the reason why, it's about 40 minutes away from Orlando. Anybody that wants to live near the beach at Cocoa Beach or in Brevard County, there's access to the beach, access to Orlando. The financial sector is good there. The health sector is good there. And you got all the jobs within Orlando. So that was my psychology around that thought process going into that. So me and Mitch are looking at these properties, and we find we're part of this group, online community, multifamily, and we found our third partner, Matt. Matt is a property inspector. To give you a little background, he inspected my single family, and I didn't even know it. I was working through his wife at the time, who sets up all his bookings. Lo and behold, we're part of the same Facebook multifamily community. We're looking at a 14 unit. We're like, look, man, you could be our boots on the ground out there. Let's partner up. Me and Mitch already had the branding ready, and we liked the CNF because it was Camo and Fortes. We were like, let's just get rid of the and keep CF. Community First Investment Group was born. From there, we purchased as a group. we JV'd on a 62 unit, and then 6 months later, we syndicated on another 41. So that's how Community First Investment Group was born. And you could go to our website and check out everything from there.
Very nice.
Let me see. Is this working? Perfect. So that's a little background on me. We focus on B and C value add multifamily asset class. People ask me all the time, Do I want to go and look at storage unit? I say no. Do I want to look at just commercial storefront property? I say no. I have a direct focus on B and C asset class. If you don't know what those are, there's A assets where luxury, B is a step down from that, C is where you're gonna get those, basically like flipping a home in a nice neighborhood, C class. So you're looking for a decent area where a mom and pop really just milked it for what it is, right? A building, tenants, get the rent, that's it. Let's put no money back into it. Those are the properties we're looking for, and that's what we mean by value add. So we have today 103 assets under management, and they're valued at a $5.2 million value. I missed the M there. Also, I created a podcast. It's called The Passive Investor Show. I work strictly with passive investors. We raise capital. So I speak on this topic basically all the time. The reason why I created it was because I was having the same conversation over and over and over and over again with these passive investors. I felt like the voice needed to be heard because these conversations are the same going forward. So what better way to have the conversation with you than a podcast? So if you understand where I was going with that. Mm-hmm. And I'm considered a passive investor consultant. Perfect. So when I'm working with a passive investor, I ask them, why are you investing? It's just kind of for me to know exactly what your reason is and learn more about your criteria and your goals. So it's family, it's, building generational wealth, it's freedom. And what I mean by that is basically a time. My time, your time is the most valuable asset or currency you have, hands down. It's not your money. It's where you put in your time. So that's what I emphasize on, because if I could spend more of it with my family and create memories, that means the world to me. And I study time. So if you hear anybody that's on their deathbed, what they want to do is they want to talk about exactly what they did in their lives, the happy moments, the things that they didn't get to do, the things that they wish they did. I don't want to live with regret. So time is important to me. People want to help give back to their communities, church charities, or they have a cause. Some people want to create scholarships in their names or their family's names and stuff like that. But how do they get there? Some people just want to travel the world, and some people, believe it or not, just want to retire early. I know I do. Do you? So another thing that we talk about, obviously, is people want to decipher between a passive investor and an active investor. This is the criteria we go through. If you want to be active, that means you're going to purchase the property. You're going to manage the manager if you're going to hire a third-party manager, or if you're going to manage the asset yourself. You're going to create these relationships to keep buying these properties and create these relationships with brokers. If you run out of money, you start not running out of money necessarily, but if you want to scale up into bigger apartments, you got to start networking with other passive investors that are seeking these type of opportunities. And most of the time, no one knows they're looking for this opportunity because they haven't heard about it before. So going to meetups is a great way. What you guys are doing right now, virtual meetups, physical meetups, conferences, a friend anyway. So, and then you got to work with reputable syndication attorneys, travel to the asset multiple times. I invest out of state. The reason why is we invest in red states. That means basically landlord-friendly laws. It's not anything political or anything. We are looking strictly at landlord-friendly states. That's everything that I just explained there ties back to your time. How much time do you want to put into it? How much time do you want to basically just allocate to being active, meaning you own the asset and you're managing and you're doing everything. Passive is the complete opposite. When you invest in a property, you're basically hiring out the work to the active investors on the general partnership side. There's two sides: general partnership and limited partner. A limited partner is a person who provides the capital and is either seeking a tax shelter, cash on cash returns, annual returns, or just looking to invest their capital because they have a ton of it and they really don't know where to put it. Usually if they have a ton of it, they're highly taxed and they're looking in that the tax benefits of it. And then the capital losing value due to depreciation, another reason why you don't want to keep your money in the bank. I don't like keeping my money in the bank personally. If I have cash, I'm looking to invest it. It's just my mindset. It's just the way I am. And I'm really trying to create multiple streams of income. So say I invested in a property and I got my capital, or maybe let's say I got 60% of that back in 18 months due to a refi, which is realistic. Let's just say I got 60% and I allocated that 60% back to another project or another investment. I am literally still reaping the benefits of project A while starting a new investment in project B. And if I really, really did my best, I saved everything that I made from project A, and I probably recouped already 80%, maybe 90% of my initial investment to move that into project B. Does that make sense? Well, we'll just keep going. I think that makes sense.
they can raise their hand, but yeah, it's.
Yeah. Another reason why passive investors invest is they don't entirely trust the stock market, and they don't mind being passive and not in control of the asset. Your investment is essentially hiring the professionals to manage the asset. Another one is another reason why people invest is, another obstacle passive investors come to find out is, how do I find them? It's not highly spoken about. It's private investing. Everybody's a private investor in this. So if three of you on this call are on the same deal, you guys don't know who's part of the deal unless you guys actually talked about it amongst yourselves, right? So it's word of mouth. How do I find these people? Do you know anybody that's doing this? So Dwaine. Dwaine knows multiple people that are operators and syndicators. He's one himself. And then you got to do your homework on the operator. You can't just, all right, I found one, take this 50 grand. You don't want to do that. I would not take your capital if you're throwing it at me like that. There's a vetting process. One, there's SEC laws from the Security Exchange Commissions that I have to follow. If I had a deal today and I met you tomorrow, you cannot invest in that deal that I just found. Now, if I met you today and we followed up a few times and I got a deal next month, you can invest in that deal. Does that make sense? I think that does. And then you got to figure out, basically you got to know, like, and trust them. That's huge. You don't give money to anybody you don't know, like, or trust. So you have to gain comfort with them before you invest. And sometimes, believe it or not, I have investors. It's taken a year before they invested in a deal. So don't be shy to ask questions if you need to get that comfort. If you got to ask the tough, difficult questions, I've heard them all. Trust me, I've heard them all. So you're not going to insult me or anything. You need your comfort. So if it's a question like, how do I know I'm going to get my money back? Or can I speak to any previous passive investors? Obviously, I would have to go and clear that with them and get their permission to be able to put them in contact with you. So I hope you guys understand that. There's a moral process to this. not only on you guys is to get to know them and know, like, and trust, but for me, I cannot put you in a deal unless we have an established relationship. And there's two ways to do it. If you are an accredited investor, if you're worth more than $1 million minus your home, you cannot include your home on that. If you're worth that on paper, you are an accredited investor. There's a defined, if you go to the Securities Exchange and Commissions, they define that accurately. And or if you make over $200,000 a year or $300,000 with your spouse a year, and you're going to be making that in the future, that's another accredited investor path. And everything else, that's for accredited investors. There are funds that allow just them. Those are 506Cs. Only accredited investors can fund those. If you're not an accredited investor, you cannot fund those deals. You cannot participate in those deals. But in a 506B, that's 35 unsophisticated investors. Those are non-accredited investors. So up to 35 of them can be in the deal, and the rest have to be accredited investors if you're still raising capital. So I should have probably created a slide for that, but no worries. And then you got to understand and define your own criteria. When you find the operator, or usually you probably do this first, right? So what are you seeking for returns? What's your criteria you're going to look for? Are you looking for somewhere to just yield? Or are you looking for cash on cash return? Or are you looking for an annual rate of return of 15? Are you looking for an IRR of 15 or 13? IRR 13 is a good start. So if you don't know internal rate of return, that's basically how fast does your money come back to you when you after you make your first initial investment. And that's done off of 5, 7, 8, 10-year holds. It depends on the operator and how long that investment strategy is. So the IRR dictates how long would it take before I get my initial capital back. And if you're looking at anybody that's doing a refi saying that they're going to do it, they're going to do this and show you what the numbers look like on a 5-year hold, but you're going to refinance in year 2, I'd be a little bit skeptical about that, because in 2 years, you might not be able to refinance that deal. So every deal you want to look at on a 5-year or 7-year, however long that operator tells you, without a refinance. Don't look at a refinance. Don't expect it. Don't even, well, you can ask on it. I would definitely ask, is the refinance part of the plan? Maybe potential, because it's a value add play, potentially, if that's the play. You want to ask and see if it's possible, because in our deals, we never model it, but we don't rule it out. The reason why we don't model it is, 1, we don't want you to expect it in year 2. 2, the reason is, I just had it. 1, we don't want you to expect it. 2, we don't want you to depend on it, saying the IRR dictated I would have got all my capital back in year 2. So that's the reason why. We want the deal to look good for the life of it, because we purchase for cash flow, long-term debt, and I forgot the third one. I think I got a slide on it. I'm sorry. But those are 2 of the 3 that we look for. So here's the process of how an investment would go, right? So you would invest in the fund. You would then seek to, so the fund is live now. We closed, we have the operating account, we have everything ready to go. We got the loan, we lined it up, we closed. You invested in the fund. Hooray, yeah, we're done, right? No, the work just started. So our goal is to look for opportunities from these poorly ran businesses, basically, from mom and pop. And we look for opportunities to reduce expenses. And we work with our property management to determine that. We're purchasing on cash flow. So we're making sure everything's getting done on cash flow. And we're renovating probably 5 to 10 units at a time, usually in that 5, depending on the size of the property. 5 is a good clip, but it's all in the process of we do it conservatively through a 2-year process. So from there, we're cash flowing, we're rehabbing at the same time. If we ever get to the point where we refinance, or if the opportunity is there for a sale in 3, 5, 7, whatever it is, there's another return on your initial capital, and then you repeat. You put that money to work. The goal is for a passive investor is to take that initial first investment, whether it's 50, 100, 400, 400,000, however they're comfortable investing. Their goal is to see how many times they can recycle that money. How many times can they recycle that capital? And the more you make your capital sweat, the more that's going to come back for you. So that's the goal. Make your money chase you. Don't chase your money. What's a great learning resource? How do I find all this out? Webinars like this. Podcasts are great. Books are great. You could check out Dwaine's podcast. He's out there. There's my podcast. There's a ton of books. Actually, I just wrote down all my audiobooks that I've listened to or read over the last 3 years. And that's only the audiobooks. It's not the books that I have on my Kindle that I read or the physical books that I actually have. The list is about 100 and something, and I'd be happy to share that. And I actually rate them too. Nothing's less than a 3, basically. There's 1, 2, 3, 4, 5 rating. Nothing on my rating system is less than a 3. So if you ever were interested in books that I read, it's all self-education, real estate, and believe it or not, there's a couple stock books in there because I was trying to learn the stock market as well. So when I don't understand something, I invest in something I do understand. So if I'm not like the person really benefiting from a deal, I can't really invest in it. And that's why the stock market had me pull out. And there's too many middlemen in there that get fat over, giving it back to the people that are actually investing and contributing to capital. That's exactly how I feel. So there's that. So this is the 41 unit. This is our first syndication that we actually had. And we purchased at one point, actually that number's wrong. We purchased at 1.61815. And I don't know why I didn't catch that. And those numbers are wrong. We purchased at 1.615, and we have a $200,000, that number is right, $200,000 budget for renovating, and I forgot the per unit amount, and we're doing the exterior and the interior, and we raised that capital. So, oops, sorry guys. So the market rate rent on that after we renovated is $100 increase. How we get there? We don't actually go ahead and move the tenants. When the tenants' leases are up, and there's a sweet science to this too, because let's just say 15 tenants are up. You can't just have 15 vacant units, right? So half of them, you attack it strategic. So you go in with a plan. So maybe 5 of them you push out to 3 months. And then another 5 you push out to 6 months. And then another 5, you say lease up at full market. Excuse me. So if they're at $500 rent, you're telling them your new rent is $600. If they move out, you got an opportunity to renovate it. Okay, so there's that. And now you can renovate those units there if they move out. If they lease up, you're in for another year, and now you got market rate rents without doing anything. And next year, if they want to be out, you can renovate those units. Or if you want to move them to a newer unit next year, you can do that as well. And we have move-in fees and transfer fees. So those are all fees that come back to the passive investors and everybody participating in that as we build up another stream of income because of move-in fees, because there's a cost add to that, to moving someone over. So we do move-in fees, which is another way of a security deposit. So we take half of the move-in fee and half of a security deposit. And in the southern states, they allow for this. So I'm from Massachusetts. I haven't seen that out here. And this is our 62 unit where this one is still being renovated. This is the one I have the meeting on tonight. We purchased it. It was Timber North, and we changed it to Buffalo Ridge Apartments. And I just got some newer pictures of this sign. We added new plants. If you go to my Instagram page, you'll see the new sign with the plants right underneath it. But we're renovating those. We had to do all those decks in the background, those gray decks that you see there. Those were basically not to code. So on a project like this, I would equate it to a single family flip. Everybody on the property is gone. No one lives there. It's a dead asset. It's not making any money. We're renovating the whole complex. It's 3 buildings. With that said, we're working as fast as we can to get it to market, because when these renovations are complete, we go from, let's just say it was a $500 rent, it's a potential of $625 to $650, and the longer we're in this project, the more the rent is going up. So we're pretty determined. You can see that their decks are ripped off here on that picture on the left, and then the decks were getting made on that one. So the decks weren't up to city code, and we had to bring those up to city code. And there's all my information. If you wanted to find me easier, you can go to thepassiveinvestorshow.com or johnfortes.com, and all my social media links are there. And that's the end of that one. And I just wanted to pull up the next one. All right. And here we go. This one, I just want to show you guys what a sample offering looks like. So we already set in a connection. We're familiar with each other. You're like, John, I want to invest in your next deal. Great. I'll let you know when we have a deal. Now we have a deal. I shoot this over to you. Hey, we got a deal. Are you ready to go? John, let me look at the marketing package. All right, cool. Here it is. So this is a sample deal. This is a fake address, a real property that we actually looked at. But this is a fake address. So here's the disclaimer. Yep, you guys got that. This is fake information and stuff. It's only literally just to show you exactly how the process is and what to look for and what a marketing package comes to a passive investor looks like. So there's the contents, table of contents there. So the executive summary. This is the deal. Purchase price is a $6.5 million, and we are looking for $2.5 million. The minimum investment per investor is $50K. The maximum investment is $460K. Believe it or not, there are investors that want to fund the whole deal sometimes, but there are first-time investors. If you're a first-time investor, always go in with the minimum. When you start getting comfortable, then you can go ahead and start saying, all right, John, I want to dump $200K into this one. Get comfortable. Investors would receive a 6% preferred with a 70% equity split. If you don't know what the preferred return is, it's, for instance, when we collect all the rent at the beginning, once the bills are paid, everything that's up top, that's left over, 6% of that goes to the passive investors, right off top, 6%. And then everything is split by the equity, 70-30. So you guys get a preferred return for investing in the deal, 6% right off the cuff. Then everything gets split to the general partners and the limited partners. And that's usually a 70-30 split, could be a 75-25 split. Sometimes it could be an 80-20. A preferred rate of return varies from every deal. It could be 4, it could be as low as 4, it could be as high as 8. Projected annual returns, we tend to average, or not average, we tend to seek 15% average annual returns. and an IRR no less than 13. Cash on cash return is usually typically 8%. Right now, I'm hearing investors are starting to settle for a 6 to 7. And I don't know if it's gone down to a 5 yet, but a 6 to 7, 6 to 8, because deals are getting so hard to come by. And then the cash flow distributions would be made on a quarterly basis. We want to get to a point where we want to make it on a monthly basis, but quarterly for now. And this tells you exactly how long the term is on this one. Investors should be prepared to leave their capital for a minimum of 5 to 7 years. This just explains that process. In the event of a refinance of the asset, investors will receive no less than 60% of their initial capital back. And upon the sale of the property, investors will receive their capital, their remaining capital in their share of the profits. So sometimes there's an IRR hurdle where if you reach that 15% IRR, the GP and the LP split the equity 50-50. But until then, it's 70-30. And this just tells you the asset and exactly what it is. It's a 48 unit. What's the unit mix? It's right on the water. All the good things about the property. Just want to know that it's a good, safe property to invest in. Not safe, but you know what I mean. It fits your criteria. Like every investment is a risk. So I try not to use the word safe. So it just makes you feel better about the property. Like concrete construction block in Florida is good. Wood frame is pretty good if it's in a certain area. You just got to know the area. You got to know what you're looking for. And then everything around it. How far is it from the supermarket? What's there? Tampa University. Okay. You got, families, you got students. Is this single family? I mean, is this a family-based apartment or is it student housing? You just want to know everything that coincides with the properties. What's around it? Busch Gardens. You want to make sure there's jobs in that area. So that's why we look for populations where the jobs are beneficial and crucial to that market, and it's not dependent on one job. So it's not dependent on, let's just say Busch Gardens went away. You still got all these other jobs and opportunities in that area. So it's not dependent just on Busch Gardens. And this is the property amenities, what it has, dishwashers. You can go ahead and reface those units and probably bump the rents a little bit more. Basically exactly what we're going to do. Sometimes, believe it or not, you find pools and they're filled in. And what I mean by that is some assets have what once was a pool and they fill them in with dirt and it's just kind of like there and it's an ugly sore. And, granted this one has a pool, but some assets just, what do you do with that? You make them into dog parks. You create a picnic area for them, create another amenity that a tenant could use. And then ample parking for visitors and tenants. You want to make sure it has that. And sometimes in Florida, what's huge is adding carports because it gets so hot. So if there's a plan and a budget for that, you want to know. And if the property makes sense for you to do that. This is a property where we probably wouldn't add a carport because it's not a B. This is a C type property. So that's what we would do. And the bathroom looks like it needs to be updated, you could tell. So we can go ahead. We can go out and rip out those tiles and add laminate flooring. Just a lot of little things that you can make this look really, really good and spruced up. The opportunity and the business plan. This is what details exactly what we're going to do. Update the cabinets, granite countertops. We're going to take this C property and turn it into a B. So now what? We might consider carports now because you want to make the tenant class higher than what it was. So you want to capture more. So we were going to spend $9,000 per unit. And I'm looking at A down here with the asset is well maintained. The pet park, pet care facility, car care center. So that was the carport. So yeah, we had a little plan for this one. And this would allow us to capture the rent premiums of 350 increasing. That's really, really good. And who would you have for property management? This is where we tell you exactly who we would be using, what kind of a loan we're using, and the exit strategy. If you see an opportunity to invest and you don't have an exit strategy in there, you better reach out and say, hey, what do you guys plan on doing with this when the holding period's done? You need to know. Because if you're going to invest $50,000 or more into a deal, you need to know how you're going to get that back. Excuse me. And this is telling you exactly the location, why Tampa, and how we underwritten it. So I want to give you guys a chance to look at. There's not much for me to talk about, but actually I'll talk about the cap rate, right? So if we're buying it at a 6 cap, when we underwrite it, we don't say we're going to sell it at a 6 cap. We want to go a couple basis points higher and say and assume that the market is worse than when we bought. And the reason why you do that is because you want to stress test it and make sure your numbers touch your numbers hit green on everything. And the reason why you want your terminal value to look worse is because we can't predict the market. We can't predict that the market is going to be this bull market that we're in. So if the cap rates right now are compressed, if it decompresses, you got wiggle room. So if that makes sense, which it should, because it's the terminal value, this is how you conservatively underwrite the asset on the exit. So that's another thing that we just it's kind of basically industry standard. Once you're in the game, you know that, you need to know that. And if you don't, I wouldn't invest. And then this is basically the part where I tell you how much money it is, what we're getting it for. It was listed for 6.9, 135 per unit. Good grief. It is a lot. So how much for the earnest money we'd need down? And we would be investing side by side with them, with the investors. The acquisition fee for us finding this property, going out, touring it, making sure it's okay, budgeting it out, how much we need for repairs, the $535,000, and the resale cap rate, the cap rate at resale, so the terminal value. So does it give me the cap rate going in? No, but on this page it did. Purchase at 6 in place. So there it is. And now, how does it look for you? Well, this is all the, I'm sorry, not how does it look for you, not yet. This is what we were disclosed from the seller documents and how we got those numbers and due to our underwriting. So they gave us there's the legend on the right-hand side. This is part of the P&L and the T12. The T12 is the trailing 12. It's exactly what they were paying for the last 12 months, expenses and their income and everything that they came in with. So it should be no surprise once we take over exactly what the reoccurring bills in place are. And this is what our projections look like, right? So the average monthly rent is $1,500, and we're trying to increase them to $1,500 by year one or upon renewal. Actually, we're trying to increase them, trying to get them to $1,591 or wherever it is. But we do it on a steady increase. We don't do it all in one shot deal, unless the formula that I told you about. If we have so many leases coming up, we want to stagger them. So we have units coming on offline and online. We know how many units we have offline at all times. So it's a sweet science to it, but you got to know how to stagger it. So I wanted to mention this, that you'll notice on a deal like this, there's no payroll. There should be payroll. You should have a staff there, a leasing staff there, or maintenance staff there. You want to have something there. Why they don't have it, why they were included on this, we made up for it right here on the management fee. Management fee on an asset like this would be 3.5 for us with our PM connections. Anything above that would go to staff. So that's why we priced it the way we did. And I wanted to make a note of that here. So always, if you're going to look at the P&L that the operator is going to send you, make sure you got the ducks in a row. Ask if there's on-site staff there. If there's no on-site staff, how far is the property management company from the asset? Why isn't there on-site staff? You just want to know exactly why. And these are going to be all our projected, these are all our projected expenses. Don't ask me why there's no trash here. That's a red flag. And gas, they probably have all electric there. So trash removal should have something. It's probably bumped in with one of these expenses. The real estate taxes is insanely high, which is expected because it's a 6.5 asset purchase price. But there's something, those two zeros right there, I would be really, but good thing this is a sample. So, and then you'll see right here how it maps out to the assets to manager, and then the member cash flow down here on the bottom, and how much the debt would be paid. And when you'll notice that it has 2 years interest only before it starts ballooning to principal. So that's why you're seeing principal 0, 0. That's a reason. The reason for that is interest only. The reason why people like interest only is it's really good to cash flow and be able to renovate those units in those first 2 years before the principal kicks in. Because after those 2 years, you're expected to be at full market rate rent, and that bump really doesn't affect your cash flow. So this is what it looks like when we sell in year 7, right? So this is how much gets returned to you guys or the passive investors. So I wanted to point that out. I add the arrow here so you guys can see that. So you'll see that the net operating income, when you purchase a property like this, we purchase on actuals, and the value of the property is tied to how the building is performing. So if the building's performing at this, there's a calculation to get your purchase price. Right here, which is now the value of the property in year 7. We bought it at 6.5, correct? Now it's valued at 9 million. If all goes well, and guess what? We even said that the market's even worse. So it could be even valued at $10 million. So what do your returns look like? Your returns look like this. This is what the whole raise looks like. This is how much we need to get there to purchase this property. But what if I contributed 50 grand? This is what your returns look like for 50 grand. At the end of 7 years, when you receive your 50 grand return of member capital, 50 grand, add up all of these, which gives you, it's not calculating your 50 grand here. So this is everything you made from the project, from the cash flow. This is everything you made from the sale, and add that to your 50 grand. You just made your 50 grand, another 50 grand. You doubled your capital in 7 years. That sounds like an investment I would like to do. So what if I invested 100 grand? You invested 100 grand, you made basically 100.7% return on your money. And let me just go back to the 50, 107. Everything's 107. So if I invested the max available, 460, I made another 495. What am I gonna do with all this? I'm either gonna enjoy all the cash flow as I'm getting it, and then use this 460 to create another stream of income when year 7 comes about. But what if the market is, what if this is a cash cow? and we want to just keep it. We have an opportunity to possibly refinance this, in year 7, and then go find another opportunity to invest that. Whether we get 60 or by year 7, you'll probably get majority of your capital back. No promises on how much, but it all depends on what the financing is allowed at that time. And you get to go and reinvest that. So now if we keep it, if we decide to keep it for another, maybe go by a year-by-year basis off of that, and it's still cash flowing the way it is, we get to go and invest that original capital in another one and create another stream of income. Like I said, the game is how many times can you recycle that initial capital? And this just tells you a little bit about myself, how I got here. You can actually find that on the website. And this is Matt. He's a property inspector by trade. He's awesome. He has a multifamily inspection company, and he's a residential property inspector as well. So I'll just give you a little quick background on what he just did. He went in and inspected a 400 unit, and this one group, he even took videos on it. It's out there on the internet somewhere. He was on the roof and he was flipping over the what's it called?
The tile?
Yeah, on the roof. He was flipping it like a deck of cards. He goes, whoever did this, and they just said they did the roof 3 years ago. This wasn't done 3 years ago. It was done 3 years ago, but he goes, they never nailed it down. So one gust of wind, like had that hurricane that just missed them gone over them, it probably would have blew them off. That's what's crazy about it. So they went back to the drawing board and asked the people that were buying it and asked for a concession to go and redo all the roofs. The company and them, I guess, the owners of that, they ended up coming out of contract because they wouldn't compensate for the roof. So he saved them a bunch of money and he gave them the right knowledge to go and do it. Plus he had video of it too. So he gave them all of that. He's good, man. I love Matt. He does his thing out there. And then Mitch, he does all about underwriting. To give you an idea about Mitch, he does my taxes personally. He's great with numbers. I just don't want to be plugging in numbers all day. And he loves it. So he's got his bachelor's in finance and he's got his taxation degree too. So he got his master's in taxation. So I brag about him as much as possible because he deals with the numbers that would give me a headache all the time. So if I was looking at him all day, I could look at the final result, but I just can't go and plug him in. And he's really great at that. So Mitch is awesome at that. And then a little bit about our team. By now, you know who Community First Investment Group is. Mike Kraus of Atrium Management. Just to give you an idea about Mike, he's co-owner of the property management group out there. I talk to him about probably once a week right now because we're looking for an asset in Florida. And he serves on the Central Florida, he's the president of the chapter of the Central Florida National Association of Residential Property Managers. He speaks at all types of panels and all of these conferences. And Amy Wan prepares our legal documents. So if you was a passive investor, you would receive and you decided to invest $50K, you would receive a subscription, a PPM, and the operating agreement. And you would have to sign the subscription, but you keep the PPM and the operating agreement just to know now that you're part of the business. The PPM basically, I forgot what it exactly stands for.
Private placement.
Thank you. Thank you. The private placement. When you're a part of a private placement, everything that could go wrong in that, basically that's what it's telling you about. And it tells you what your returns are going to look like and everything else. So it also tells you on the how much shares you have and all of that on the OM. But if you really want to get into the guts of it, the private placement would be the one that you want to review. And actually, I just did a podcast episode with her explaining why you should be reading that. A lot of experienced ones, investors, know what it's all about. So I know they review them at the end of the day, but we stress to read those. Those are very important. And this is how you can reach me and ask questions. And matter of fact, we can open this up right now to any questions. I know I talk fast. I'm sorry.
Yeah, very good though. Let me see here. Yeah, you could be able to unmute. You just click on if you're on a phone, I think there's a button there you can unmute as well. So yeah, anything you can think of, please ask.
So yeah, I know I dove into that. Where go back here.
John.
Yes.
Yeah, you talked about JV, and I guess on the 63 unit.
Yes.
That you guys heard. Can you talk more about JV and like what does that mean? How does that process work?
Absolutely. So, hold on. 1 second. I'm trying to see you guys. All right. So what the JV is like. So Dwaine, me and you got a property and we want a JV on that. All right. I got all the money. You got all the experience. What do you want to do? How do you want to split this up? All right. So how about we go 50-50? Is that cool? All right, cool. So that's a JV process, right? So it's knowing exactly how much you're gonna make on your capital, but also you want to go in with an idea of, you want to go ahead and be like, look, Dwaine, if we're gonna JV on this, no one sees any capital until I get my initial investment back. Like you can dictate the terms on exactly how you want to do it because you have all the money. But if you have all the experience, you can leverage your experience as well. So you want to get compensated for what you're doing, right? So you got to make sure you guys come to an agreement and really know exactly who stands where. So I would never JV anything over a raise of, for instance, if it took anything around that $450,000 to $500,000 to get a property. I would never JV, I would do a syndication. And the reason why is because you're probably gonna raise from maybe 7, 8 different people, depending on your raise contributions amount. So that's a great question, Milton.
Thank you.
No worries. Is my screen share still on?
Yeah, I think so.
I'm trying to turn that off. Oh, right here. I got it. Boom.
Okay.
Now, the syndication process is a little bit easier where maybe it's about 4 or 5 people in that general partnership, excuse me, and everybody else, you want to syndicate bigger deals. And the reason why is, as a passive investor, it's less risk. You're sharing the risk with, let's just say everybody on this call, there's about 8 people, and Dwaine is the general partnership. He's running the show, and all the rest of us, 7 of us, are just limited partners. We give Dwaine the capital. He runs the show. We sit back and enjoying the profits. Dwaine sits there and emails us with a monthly or quarterly newsletter. It'll start off monthly because in the beginning, you want everybody to know exactly what's going on, what's up with the property and this and that. We're turning over units. The property management company did this, this, and this. And you want to make sure you have all your ducks in a row on that aspect. And then as the checks start rolling in, people start loosening up and seeing that it's really working. It's really doing its thing. It's really doing, Dwaine's doing exactly what he said. And now he can go from monthly statements to now quarterly statements. And as he gains experience, he can probably just go quarterly statements from there. But I always like to do monthly for at least the first quarter. And then, depending on the project, give out quarterly newsletters along with quarterly distributions. Any other questions? Dwaine, you got a question?
You pretty much went, because when we was going to talk earlier, I was asking you about all of this stuff, and you you went through kind of everything that I would ask for. Well, that's all I can think of. Yeah, you went
Okay.
over the 506C, which was a question we had at the meetup.
Yeah.
Was trying to see because sophisticated investors get involved in it compared to just accredited investors, where that's kind of the buzzword that you hear on the internet. So the difference between that, and you talked with Amy. I actually interviewed her as well. Extremely knowledgeable, and
It's
she
awesome.
broke it down perfectly. So that's a very good person to have on the team.
Yes. Amy is, I'm going to bring her back on because we got several other topics to talk about in regards to what a passive investor should look at. And we thought the private placement was very important to start off the first one. And, she stands by that too, to this day. She's really, really good at what she does. If anybody has, I wouldn't want to waste you guys' time, and I wouldn't want to waste her time. So on her website, you could schedule a meeting with her just to get an idea. But if you're at that level to go and do something, but I asked her, I said on the interview, I said, Amy, how would we know if these documents are really drawn up by an SEC attorney? And she goes, well, you should be able to ask the sponsor who drew up the documents. And if it really meant that much to you, you could reach out to the person that drew up the documents. So if you really, really went down that road, because I would want to know everything, right? So at least names. Just give me the names, and maybe I can go contact them later if I care that much, right? So, and that's why we put on exactly who we're working with and exactly all the members of the team. And sometimes you'll see packets where people are putting together things and they'll say this is their mentor, this is who is standing behind them and stuff, and just like, and use a big industry name, which is really true because they have the ties to them. So if they're using their name, they got basically the cachet from them to say, okay, yeah, you can put my name on that.
I know you got Florida, Tennessee. Are there any other markets that you're looking at right now, or are you just kind of focusing on that Southeast area?
So we got Tennessee is where both of our assets are at. And right now we are we've been exploring Florida for the last year, since last year. So we've been creating relationships with brokers, which is the hardest part because they want to know if you're credible. They want to know if you can close a deal. And yeah, I can say, yeah, I got 103 in Tennessee. Okay, yeah, next level. So now when they send me a deal, am I real? Am I for real? So now when I'm saying, look, this deal doesn't meet our criteria. And our criteria is what our investors are looking for in return. So we do all of our deal analysis based off what we would invest in or what our investors would invest in. So if the opportunity looks promising, if we have a deal, basically, I haven't shown my investors a deal since January. And what's funny is I just sent out a newsletter on that to them saying, look, the last time we sent you guys a deal was in January. And the people that, like, our investor database has grown since. And there's people on our investor database that have not seen a deal come by their desk from us, just our monthly newsletters. And there's a reason for that is if we were in the game to just get buildings under contract, I can go and I can make offers on everything at full ask and get in the game. But that's going to damage my reputation with the broker because I'm going to come back and say, all right, I got the deal under contract now, but we can't buy it at this price. We want to buy it here. And the broker is going to be like, John, I can't work with you. So whenever we put an offer in, we do probably about, for the month of August, June, July, and August, we had about 6 LOIs basically a week out on properties we're analyzing, So we were really, really putting them out there, but they weren't all at full asking. So if they all came back, we would have been, a great problem to have, but they all got rejected. Some were really close. Some we missed by 200K. Some we missed by 500K. Some we made it to a discussion. And then, for instance, the property that you guys just saw in the sample, the actual property that we looked at, we were really close. And you saw that we were 400K apart, but we were literally about to purchase that at that price. And we found out it was 3 buildings. 1 building sat in a flood zone. That conversation with the broker, we backed out and he didn't like it. So he was like, he asked me 2 things. He was like, is your deal, is your offer wiggle room? I said, on this deal, there's no wiggle room. We're right there where we want to be. So on the next question, he goes, and why do you want to back out on that one if one property sits on it? I said, because insurance, and we got insurance quotes on this as well. It's not like just because we looked at the FEMA flood maps and we were like, we're out. We went and we got actual quotes, and it was too much to bear. It crippled our investor returns. And I said, look, I can't purchase this because I can't put my investors in this deal.
Yeah, that's smart. Yeah, it's a lot of work. And you have kind of broke down what it would take as an active investor, which is what you're doing, compared to on the passive side. So that's why I'm kind of glad that we're talking about both, because for the group, we just want to give those options. Some of us want to probably do it on their own, and we want to provide all that education and all of the stuff that can go wrong, stuff to look out for, so you can kind of get the best opportunities. Or you can kind of take it on the passive route. A couple of us probably get together and buy a project. So, but at least you got to know what's involved. It's, some people, like the broker was telling you, you could probably buy it. It's just only 1 building, but you putting that risk, for the investors was too great, and it would, damage potentially the business plan and your reputation. It's better off to go a couple months to find that perfect deal where everything's going to work out, and then you'll be able to recycle that money again.
Absolutely. There was one more point I want to touch on in regards to that process is it's time consuming, it's relationship building, and the broker really probably if he puts out another deal and I go and look at it and come back to him, he might not even consider me on it unless I'm really, really close at the top with the other competitors. But that's the risk I take with buy one got a deals, because of the opportunity that it just won't work. I think we got a question from Pat.
Brother Pat.
Hey, John, how you doing? So a lot of good information here. I want to touch upon the reposition. So the building that you had 0% occupancy, how do you talk to your investors? How do you get your investors engaged into a 0% cash flow for a certain amount of time? And then how do you, what's the short-term debt? What's the long-term debt on that? Do you do a bridge loan? Do you do construction loan? What do you do with that? How do you get them to buy into a deal like that? Because I'm looking at a building in St. Louis that's 70% occupancy, but 16 units are down. There's a fire, the whole bit. So how do you get a long-term debt on that? Fannie and Freddie won't loan on anything under 80%. So how do you get your investors? What's the bridge, I guess?
This message is for Aaron Robinson. This is Nancy with UPS. I need you to call me so I can get into your UPSers.com so you can get paid. If you do not do so today, I cannot pay you. I do need to enter that today. Please ensure the importance of that. Give me a call at 646-430-2030. Thank you.
anyways, yeah, I'm just, so the reposition thing, can you talk a little bit more about that?
Sure. So all my investors in that 62 unit, all my partners in that, that's not my passive investors. Those are my brothers in that we met in a community, and we're all basically JV'd that. So if you have a bunch of people with like-minded individuals that are willing to go ahead and on that deal and take it over, you got to have a really nice, decisive and concrete plan to convince everybody to be in that deal.
Yeah.
None of those people are passive investors in that deal. Everybody in that deal, we talk basically almost every day about deals we're coming across because we want to partner up together on other deals, on the general partnership side, on deals that we're syndicating. Going forward, if we ever, when we refinance our capital out of that, we're looking for another opportunity to, as a team, JV into more deals as a team. So that's our focus on that one. But you gotta know your partners, you gotta like them, and you gotta trust them. It's all part of that. It's just like a passive investor looking at, why would they invest in your deal? So to go back on the financing piece, you're probably gonna have to go in with a bridge loan. Fannie isn't touching that. Freddie isn't touching that. Our deal, our 62 was 70% occupancy, maybe even 60. And it had no down units really. They just need to be renovated. But the decks were the biggest issue, and we put $100K in the decks alone. So if I was to go ahead with bridge debt, get something that comes with exactly what we got on this one. You wanna get debt that'll give you some of the repair funds. And if you're gonna get repair funds on a loan like that. So for instance, on the 62, we bought it for 1.2 and the loan is a total of 1.7. So they're giving us 500 grand to repair. They don't give you that money up front because they might think you're going to run away from them or whatever. You got to have the money to go ahead and do the work, and then they come and inspect it, and then they draw it back out to you. So it's done on a draw basis. It's almost like a lot of flippers deal with that with some private lenders where, all right, yep, I saw the work. All right, I'll release another 20 grand to you. So that's how it works on that scale. But if you're going to go that route, those loans are usually 1 year. You better have your plan to refinance or stay fully stabilized within that year. So right now on our 62 unit deal, we're touching that year mark. And the reason why is it took us a long time before we emptied out the building and started working. So when we closed in October, we closed in October last year. We didn't start really renovating until about February or something like that. I believe it was February. And that killed us on time. So what you want to do is you want to go ahead and repair those fired units immediately upon takeover. I'm talking about day one, have a crew in there. Because time is not on your side. You got a year for a bridge loan. And then when you get those done, you want to take units and you want to communicate to your tenants that have lease. For instance, when you're renovating those 16 units, those other tenants that come up on lease renewals, you want to extend them or keep them month to month. Excuse me, month to month until those units are fully leased. I mean, fully finished, refurbished. Move those month to month tenants into there. From there, now you got 16 16 more units opened. Do the same thing. And if a ton of tenants are like leases are coming up upon renewal at the same time, you want to stagger those leases. So you want to say, all right, I'll give you lease up at the same price for another 3 months, lease up for 6 months, lease up for 9 months. because you want to make sure your tenants are there, because as long as your tenants are paying, you can fully fund your deal with the capital that you raised and closed on and out of your operating account, and not have to bleed money because you're paying back the bridge loan, and it's only interest only on the bridge loan that you're paying for. So you want to pay that through a break even, at least have a break even amount where if it's 50% occupancy, all your expenses are paid and you can still complete your business plan. If you're not doing that, you're going to be bleeding money. So right now we're looking to pivot into another lender right now and see if that's what our discussion is right now coming about tonight. It's the fact that we took too long to start the rehab process when we should have started it immediately. And that's the renovating the units. We started the decks pretty much, not immediately, but sometime.
Yeah, and I think that's my biggest concern about the reposition, right? So the building is barely cash flowing, but it's because 16 units are down out of the 60, and then there's a couple of vacancies, so probably another 10% vacancy. I don't even know about economic vacancy, so throw another 5% in there. So it's probably 65% at best vacancy.
And it's not cash flowing. What's the break even? Find the break even number, and that's it. Yeah. That's the key, break even. And another thing I would plan for the worst. Plan for the mass exit. Because sometimes tenants, when they see new owners going to renovate units, they're like, oh, my lease is gonna go up on the next renewal.
Yeah. So that's the thing, is that I'm trying to underwrite this thing conservatively because just of the Murphy's Law, right? So anything that's going to happen will happen.
It's going to happen. Yeah.
And the bridge loan, I totally get it. I'm trying to get this thing into an occupancy of 80% so I can get long-term debt on it. I was just concerned. I was curious to see how you play that out to your investors to say, all right, you're not going to make any money first year because we don't have any cash flow on this. We're going to rebuild this whole deck. We're going to redo we're going to make this thing rent ready. Let's go. Here we go. But you're not making any money year one, maybe not even to year two. How do you communicate that to your investors?
So if I was going in day one and I was going to syndicate this deal, I would make sure that I wouldn't have to go back to them and do a capital call. That's first and foremost. How much do I need in the operating account to make sure I am doing this? 2, I need boots on the ground. Who's my boots on the ground that can be at the asset every day? Anyone partners involved that could be there every day? Because contractors, you need them there. You need them working. If they're not working, you're not going to get it done in time. So investors, how do you angle that? You're going to tell that, you got to be honest, but look, you're not going to get cash flow for 2 years. But when it's up, and I'll just give you the number on ours, our 62 unit, when we cash flow, I said on Dwaine's podcast, 17% cash on cash return. Right now, because we had to do we had to fund it again because another capital call, we'll be at 14% cash on cash return once it's fully. So those cash on cash returns are really, really high. That alone is kind of there, but do you have the experience to be able to handle a job like that? Do you have the team on the ground to be able to do that? Who's your property management company? Just basically, you got to have all those answers.
Yeah. And so this will be my first deal.
Yeah, that's a heavy lift. A heavy lift on a first deal is really tough.
Lift. Yeah, it's a heavy lift. So
unless you're going in with an experienced team behind you, like, I don't want to discourage you. I think if you can do it, you can do it. But can you do it from Connecticut, where you live?
Yeah.
That's the thing, right? You
that's
gotta
the
have a
thing.
team.
Yeah. So it's interesting because the only time, and I'm sorry to take up all the time, but
Nah, go ahead. It's a great question.
you know, the only deal you're going to get is a distressed seller, a seller that's desperate. This guy's desperate. And, you know, but there is, so, and we're looking for value add, right? So this is a value add play. The potential's there. It's just that, like, you know, for a first deal, a reposition, you know, it's barely cash flowing as it is. It's not in a great part of town, but there's a path of progress going on. So in that part of the city, there's a lot of different stuff going on that's helping it out. So it's going to be a better neighborhood come 3, 5, 7 years.
Yeah.
The problem is that, you know, how do I manage that construction piece of it with the property management piece of it, with being my first deal? You know, there's a lot there. So
yeah, even if you were to get agency debt on that, you would need someone boots on the ground at least 100 miles away from the asset, at least 100 miles. And that's just requirements of Fannie for them to feel comfortable to fund it.
Yeah.
So you're not gonna get agency because of the occupancy and just because of the state of the condition. But a bridge lender will fund it and give you a lot towards the rehab. So you know, you just got to make sure you have a good bookkeeper and you underwrite it conservatively and well done to make sure you have that CapEx budget so you don't have to go back to your investors.
Yeah, for sure. No, this is good, man. This sparring back and forth, I appreciate. So, Dwaine, I don't want to take any more time.
No, it's good. It's a good question. It's you know, definitely helpful to the group. Where you said that deal was again? You said Kansas City, Missouri?
St. Louis.
Hey, quick question: have you visited the property? Have you toured it? Have you walked it?
No.
Yeah, you need to tour it or have someone tour it for you.
I'll give you a contact. A guy named Logan Freeman.
My man Logan.
Yeah, he's. I don't know how far away. If you need a
he's
team,
in Kansas City, right? In Missouri.
Yeah. Give him a call. He'll. You know, he's very knowledgeable. So I'll give you his information, Pat. You can check him out.
Beautiful. Yeah, it's so. The broker was like, I know, I'll drive it and I'll take pictures. I'll let you know what's going on over there. She's like, you know, it's a C property. It's, you know, or C neighborhood. It's definitely a C property. So she's like, you know, underwrite it. Let me know what your number comes in at. You know, she's like, basically, don't waste my time driving an hour over there. But yeah, so that's why I was like, you know, because it's not a huge reposition. You know, it's already 70% occupancy, but there's 16 units down. I figure, you know, if we can at least get something to cash flow net, and then bring those 16 units up to rent ready. Now I think you got something, and the area's a path of progress. So there might be a little bit of appreciation in the next couple of years. You might have something there. So
yeah, just don't purchase off appreciation though.
Of course, yep.
That's what got everybody in a way.
Yeah.
Yep. So that's the biggest thing. You want to purchase off of long-term debt, cash flow, and have a good cash reserves. That's what I was missing earlier. Cash reserves. You want to make sure you have cash reserves. So, yeah, that's exactly what that type of a project would need, except for the long-term debt, because you're going on a bridge. You need cash reserves, like a good amount of cash reserves. And you need to make sure that you have boots on the ground to make sure that there's a construction team working at the property every day. And
John, is that from the oversubscription, or is that for the cash reserves? And then how would you handle
cash
that?
reserves? So like cash reserves is how much do you have there just in case there's, you know, so nothing goes sideways, right? So the oversubscription, for instance, if I put out an offer for $1 million and everybody on the list says, you know, I want in, and I got, you know, 1.5 million, I have to come back and tell some people they can't participate, wait for the next one. So I would have $1 million easily raised. That's an oversubscription. But as far as a cash reserves, you want to make sure you have enough in your CapEx or your repairs and maintenance fund. So repairs and maintenance is what you're saving, whether sometimes some people use a rule of thumb of $250 a year per $250 per unit every month, right? So you're taking $250 per unit a year. I mean, yeah, that's what it is. So if it's 100 units and you got 250, so you're putting away 25,000 a year, right? So I think I got that number right? So yeah, I didn't calculate or anything. But anyways, you're putting that money away for a rainy day fund. 100 units. Let me just make sure I got my math. 25,000 a year is going straight for that. And you're never touching that. That's coming off as like an expense, right? As part of the budget, as part of your plan. And that's a rule of thumb. Don't take my word for that, because I always tell people, if you're investing out of state, make sure you know how much you need for reserves. Every market is different. So in Florida, it's probably like 350 for us. Tennessee, yeah is different.
Yeah. John, I just underwrite at 300 per door, and then add in 2 months of monthly expenses.
Yeah, the lender's going to tell you exactly how much they need in there as well. So, yeah, and that's for like just unexpected roof repairs or something that just goes sideways, where all right, it's not touching our CapEx budget going in to go and do this project. Now we know what we're dealing with. So great question, Pat. Great question.
Yeah, very good, Pat. I like that. Have you guys done any cost seg studies?
Oh yeah. So on the 62, we did when the building was cleared, before we did any maintenance to the units, we cost segged it. And yeah, Massachusetts doesn't allow me to capture for bonus appreciation, but it would have been nice. So that would have been nice. So even as a passive investor, you do get those tax benefits. So if there was a cost segregation done on an asset, it allows you to capture those benefits where basically everything you're making passively, and please consult an attorney or a tax accountant for this.
Or Yona.
Yeah, Yona's the man. So if you received, let's just say you made, I don't know, 15,000 last year of passive investments and you cost seg, there's a good chance that you can basically shield yourself from paying any taxes on all of that 15. So all passive investments are all basically wiped away. And then if you don't exhaust it all, you can use it in later years as well. So for instance, let's just say you made 15,000, but your cost seg amount came out to 30,000. Now you got 15,000 to use in other years, and it just keeps rolling down and rolling down and rolling down. So the tax benefits, and now you can see why the wealthy invest in this manner. It's just unlimited. It's you're doing exactly what the government tells you what to do. You're doing exactly what the government tax code is telling you what to do.
Mm-hmm.
So do what they tell you to do, and that's how you get wealthy, remain rich, and preserve your capital. Because each day, if you think about it, right? So let's say the SEC, I believe it is, they are expecting every year 2% inflation. 2%. That's what they want. Every year they want inflation to go up by 2%. Every year your money is getting wiped out by 2%. So if you're keeping it in the bank, you're actually losing money. And I don't know about you guys, but growing up, everybody says, save your money, save your money, save your money, put it in the bank. Okay, I put it in the bank. Even if I put it in the mattress, I'm losing money to the inflation every day. Whether I have it in the bank or in under my mattress at home, I'm losing money. The only way even in the stock market, you're losing money on that, because if you're making 8%, it's still eating at your dollar in the stock market. So you're really making 6%. If I'm doing it via a cash flow and asset, and I keep turning over my capital every time, what I mean by turning it over is reinvesting it every time I receive it back. I'm actually hedging myself against inflation, because as the dollar gains, or as the dollar is less every day or whatever, the dollar's worth more today than it is tomorrow. Put it this way, rents are going up every day. Tell me a point where rents are going backwards. And you make money. So that's how you hedge against inflation. If that makes sense, just let me know if I can clear it up for you. But as rent increases every year, your dollar is hedged against the inflation. So instead of saving it in the bank and you got it in one of these, say you got a $50,000 in one of these funds, every year the rent goes up, let's just say the minimum 1%, or let's just say 2%, just in line with the economy. Your dollar's not losing value because you're staying with it. Does that make sense?
Mm-hmm. Yeah, it's good. Yeah, good explanation. Anybody else? Brothers, sisters? I'm pretty sure there'll be more flowing in tomorrow morning in the inbox, and we'll forward it over to John, and we can get back to us and stuff. And we can also get him back for some other topics in the future. Yeah. Get some really deep dives, look into some other deal case studies, so we can kind of get some practice looking at the numbers on the active and passive side. And until everyone's kind of gets ready, that they feel comfortable later on in the future, you'll be further prepared. So, Brother John, I really appreciate it again. Taking the time, kind of going through the presentation was excellent. Answered all of my questions, and especially in the podcast as well when we did it. But yeah, we're definitely gonna have you back. If not on virtual, you're gonna have to take a little drive up from Boston to come see us.
Absolutely, I'd love to meet everybody.
Absolutely. So yeah, the group is growing day by day. So I know it's the first virtual. So we had 15 registered, and it's gonna get bigger. So get people comfortable. But any last parting words? Anybody's good?
I just thanks guys. This is great. Dwaine, good first start, man. This is awesome.
Absolutely.
I know it's not an easy endeavor, connecting everybody and the whole bit. So great job, man. And John, great job with the presentation. Thank you.
Thank you for the questions, man. You're asking great questions. Dwaine, thank you for having me on. Appreciate literally being a part of what you guys are doing. Like I said, time is everything to me, and I appreciate you guys allowing me to be a part of your time. So thank you.
Yeah, absolutely.
Thank you, John. Great job.
Thank you. Appreciate you guys. You guys have a great night. Feel free to reach out to me. I'll be happy to answer any questions. Pat, let me know how you make out. I appreciate you guys. Thank you again.
All right. Take care, Brother John. We'll talk to you soon.
Indeed. God bless.
All right. Take care.